IND AS 115, Revenue Recognition from Contract to Cash by CandiMentor.com. Hello and welcome to CandiMentor. Today, we're diving deep into IND AS 115, the Indian standard that governs revenue from contracts with customers. This standard replaced the old AS 9 and fundamentally changed how and when companies record revenue. We'll walk through each concept step by step, from understanding contracts, identifying performance obligations, all the way to recognizing revenue when control transfers. By the end, you'll not only know what the 5-step model is, but also how to apply it in real business situations. Let's begin. Question number 1. Objective and scope. Purpose. IND AS 115 aims to provide a single, comprehensive framework for recognizing revenue. Its goal is to ensure that companies report revenue in a way that faithfully represents the transfer of goods or services to customers, in exchange for an amount that reflects what the company actually expects to receive. Where it applies to almost every contract with a customer, including sales of goods, rendering of services, long-term construction projects, and even contracts to build customized assets like software systems or specialized equipment. Where it does not apply, some areas fall outside this standard. Lease agreements covered by IND AS 116. Insurance contracts under IND AS 104. Financial instruments governed by IND AS 109. And non-monetary exchanges within the same industry, like two media companies swapping ad space. In short, IND AS 115 applies wherever a company earns revenue by transferring goods or services, unless another standard specifically covers that arrangement. Question number 2. Core principle. At the heart of IND AS 115 lies one simple but revolutionary rule. Recognize revenue when control, not risks and rewards, passes to the customer. In older standards, revenue was often recognized when risks and rewards shifted. Now the focus is on control. That is, when the customer gains the ability to direct the use of the asset and obtain its benefits. For example, if a company sells a machine but retains control until installation and testing are complete, revenue should not be recognized at dispatch, but only when the customer actually controls that machine. This approach ensures revenue reflects economic substance, not just legal form. And because judgment plays a big role here, every decision must be supported with clear documentation. Question number 3. The 5-step model. Overview. IND AS 115 introduces a clear 5-step model for revenue recognition. Identify the contract with a customer. Identify distinct performance obligations within that contract. Determine the transaction price, the amount expected in exchange for goods or services. Allocate the transaction price to each performance obligation based on standalone selling prices. Recognize revenue when or as the performance obligations are satisfied. This framework promotes consistency, transparency, and comparability across industries, whether it's a construction firm, a SaaS, software as a service company, or a telecom provider. Question number 4. Step 1. Identify the contract. A contract under IND AS 115 exists only when 5 conditions are met. Both parties have approved the agreement and are committed to fulfilling it. Each party's rights are identifiable. The payment terms are clear and enforceable. The contract has commercial substance, meaning it will genuinely affect the entity's cash flows. It is probable that the entity will collect the consideration due. If multiple contracts are negotiated together, say a construction contract plus a maintenance contract, they may need to be combined if they form a single commercial package. Similarly, if terms are later revised, a contract modification may occur. Here, the company must assess whether the modification creates a new contract for new distinct goods or services, or adjusts the existing one. Question number 5. Step 2. Identify performance obligations. A performance obligation is each distinct good or service promised to a customer. To decide if something is distinct, 2 tests apply. The customer can benefit from it on its own or with other readily available resources. It is separately identifiable, not heavily interdependent with other promises in the contract. If both apply, it's distinct. If not, it's combined. For instance, in a software arrangement that includes a license, installation, and support, each may be treated separately if they can stand alone. However, in a construction project, all components usually form a single combined obligation, because the customer receives one integrated asset. Number 6. Step 3. Determine the transaction price. The transaction price is the total consideration the company expects to receive in exchange for fulfilling its performance obligations. This can include fixed amounts agreed in the contract, variable consideration, such as performance bonuses, volume rebates, or penalties, non-cash consideration, like shares or barter goods, a significant financing component if payment timing and delivery timing differ. When the consideration is variable, management must estimate the amount using either the expected value method, a probability-weighted average, or the most likely amount method, single best estimate. However, only the portion that is highly probable not to reverse can be recognized. This is called the constraint on variable consideration. Underline. Number 7. Step 4. Allocate the transaction price. Once the total transaction price is determined, it must be allocated among the identified performance obligations. The allocation is based on each obligation's standalone selling price, that is, the price the entity would charge if sold separately. When direct prices aren't available, companies can estimate using adjusted market assessment, referencing market prices for similar goods or services, expected cost plus margin, estimating cost and adding an appropriate profit margin, residual approach, using the difference between total contract price and the sum of observable standalone prices. For example, a telecom company selling a handset with a data plan must split the total price between the phone and the service based on relative fair values. Discounts or bonuses are allocated only when they clearly relate to a specific obligation. 8. Step 5. Revenue recognition timing. Revenue is recognized either over time or at a point in time, depending on when control transfers. Over time applies when the customer simultaneously receives and consumes benefits as the entity performs, like in maintenance contracts. The entity creates or enhances an asset the customer controls, like a building on the customer's land. The asset being created has no alternative use, and the entity has an enforceable right to payment. If none of these apply, then point-in-time recognition is used, typically when goods are delivered or control clearly passes to the customer. For example, a builder may recognize revenue over time, while a retailer recognizes revenue at the point of sale. IND AS 115 provides several indicators. The customer has legal title to the asset. The customer has physical possession. The customer now bears significant risks and rewards. The customer has accepted the asset. The seller has an enforceable right to payment. These clues must be evaluated together, not in isolation. For example, a company delivering goods to a consignee hasn't transferred control yet because it retains control until resale. Or a pharma company may give distributors volume discounts. Revenue is recognized only when those outcomes become reasonably certain. 11. Significant financing component. Sometimes there's a long delay between delivery and payment. If that delay significantly affects the value of consideration, there's a significant financing component. In such cases, the company adjusts the transaction price for the time value of money, using a discount rate that reflects a separate financing arrangement. If the gap between payment and performance is less than 12 months, the effect is typically ignored. Interest arising from this adjustment is recorded separately as interest income or expense. 12. Non-cash consideration and consideration payable to customers. When a customer pays in non-cash form, say shares or goods, the consideration is measured at its fair value on the contract date. If the company itself pays something back to the customer, for instance, rebates, coupons, or loyalty credits, this is generally treated as a reduction in the transaction price, unless the customer provides a distinct service in return. 13. Contract modifications. A contract modification occurs when the parties approve a change in scope or price. If the added goods or services are distinct, the change is treated as a new contract. If not, it modifies the existing contract and may require adjusting both revenue and progress toward satisfaction. For example, a construction project expanded midway through the contract would likely be treated as a modification, requiring recalibration of total revenue and costs, incremental costs to obtain a contract, such as sales commissions. These are capitalized if recoverable, or expensed if the contract term is short, less than a year. 2. Costs to fulfill a contract, such as materials, design, or setup costs that directly relate to future performance. These can be capitalized if they generate or enhance resources for delivering future obligations. Capitalized costs are amortized in line with revenue recognition and tested regularly for impairment. 15. Presentation in financial statements. IND AS 115 introduces 3 key balance sheet items: contract asset, work performed but not yet billed; contract liability, payments received in advance for work not yet performed; receivable, an unconditional right to payment. These items reflect the timing difference between cash movements and performance obligations. Companies must disclose the opening and closing balances for transparency. 16. Disclosure requirements. Disclosures under IND AS 115 are far more extensive than under AS 9. Companies must disaggregate revenue by product type, timing, over time or point in time, geography, or customer segment. Explain judgments and assumptions made in applying the standard. Report contract balances, changes in those balances, and the remaining transaction price yet to be recognized. This helps investors and analysts understand both the pattern and predictability of revenue flows. 17. Key differences from AS 9. Compared to AS 9, IND AS 115 represents a complete shift in thinking. The old model focused on risks and rewards. The new one centers on control. It introduces performance obligations, variable consideration, and financing adjustments, all absent earlier. It also brings detailed disclosure requirements, giving users deeper insight into how and when revenue is earned. Most importantly, IND AS 115 resolves long-standing issues with multiple element contracts, which AS 9 did not address clearly. Industry applications. Let's see how this plays out in specific sectors. Software. Separate revenue recognition for license, customization, and maintenance. Software as a service, SaaS, is usually recognized over time. Real estate. The old percentage of completion model is replaced with a control-based model. Revenue is recognized only when the buyer gains control of the property. Telecom. Bundled contracts, such as handset plus service, are separated into distinct obligations, each with its own timing of revenue recognition. Manufacturing. Bill and hold and consignment arrangements are tested carefully to determine whether control has passed or still rests with the seller. 19. Practical challenges and judgments. Applying IND AS 115 often requires significant professional judgment. Common challenges include deciding which promises are truly distinct, estimating variable consideration accurately, handling contract modifications without double counting revenue, managing deferred revenue tracking across periods, updating ERP systems to reflect contract assets, liabilities, and disclosures. Success depends on tight coordination between accounting, operations, and IT teams. 20. Summary and checklist. Before closing, let's recap your checklist for compliance. Then, confirm the contract's validity and enforceability. Then, identify all distinct performance obligations. Then, determine and allocate the transaction price correctly. Then, recognize revenue when control transfers. Then, disclose judgments, assumptions, and balances transparently. Applying these steps ensures your revenue recognition aligns with both economic reality and accounting integrity. It's about the story of how value is created and transferred. IND AS 115 makes that story clearer by linking revenue directly to performance and control. So take the time to apply the 5-step model thoughtfully. Document every judgment, and let your financial statements reflect not just what you sold, but when, how, and why. Thank you for learning with CandiMentor. For more modules on accounting standards, audit readiness, and corporate reporting excellence, visit CandiMentor.com.